Welcome to a BSA AML webinar. We're going to talk through all the things that you need to do to at least fulfill one column of the AML 4 columns of management, right? It's the regular training part of that thing. Today, we are going to cover down on BSA AML, red flags, reviews, structure, and through MLOForce, when Bob's all done, we'll actually send out a certificate to those that have attended and fulfilled the entire seat time of this course. We'll take about, 50 minutes, Bob? I think that's what we'll cover on.
We should be right on that amount. Yeah.
Right about 50 minutes. If you got any questions, definitely feel free to hit the chats and put your questions in there. Rin's running production on the backside, and he's going to check on those things for us. Other than that, BSA AML is all about good storytelling. That's not entirely true. It's about storytelling that helps teach to watch out for the flags and the structures of what we're looking at. So, Bob, if I said I just layered that intro in, it wasn't money layering, but it's close, right? I did pretty good.
You done fine, Nate. You done fine.
Thank you.
Okay.
Well, Bob, you're a Daylight AML, BSA AML specialist, a guy who's done more fraud investigations than anybody else I personally know. And so that's a pretty good, right? I didn't say you're the best, but I said you're my best. That's for sure. And I can say that completely and holistically. So take it away, Bob. What do you got for us today?
I got some good stuff. Mortgage fraud is probably at the center of the reason why BSA even applies to mortgage lenders. The federal government decided in 2012 that the BSA rules apply to mortgage lenders, even mortgage brokers. And, before then, we didn't even think about it. I always tell people until 1986, money laundering wasn't even illegal. So our world changed in 2012, actually February 14th, Valentine's Day. Happy Valentine's Day. 2012, the government decided that all mortgage people have got to behave themselves according to the BSA regs. And one of the duties that you've got is to control your risk. So what are the points I want to make today? That experience counts, that you veterans in the industry can help the juniors to come along and be better at analyzing your own risk. And the second thing I want to point out as we start is that regulators are noticing deficiencies. They're writing people up for not having an adequate risk assessment, right? So we don't want to do any more than we have to on the compliance front. But when the regulators start hitting you because you haven't done a good risk assessment, you've got to do a better job. So we're going to talk today about the chief risk that you've got, which in the mortgage world is fraud, and that's fraud that has to get reported through a suspicious activity report to the federal government. So that's where we are. That's what we're going to look at today. So I've got probably a dozen different fact patterns here. They're all good stories, and they're going to help us establish some principles to help you control risk. So I start here. This makes me laugh because, yes, 60 Minutes called me for my opinion on a story they were doing, and they said, "Do you want to be in the show?" And I said, "Absolutely. I cannot turn that down." I have longtime friends who say, "Simpson, how long are you going to keep bringing up 60 Minutes?" And I tell people this is my Rolling Stones Satisfaction or my Garth Brooks I Got Friends in Low Places. This just gets played at the concert. Okay, it just does. I don't think I take any joy in it anymore, but you got to understand, I go way back with mortgage fraud issues, and I ran for 25 years the largest mortgage fraud investigation company in the country. So if we have to start today and say, why should you listen to Simpson when he talks about mortgage fraud? This is why. I, at a minimum, oversaw or conduct 70,000 different mortgage fraud investigations running IMARC from the crash for the next 10 years. So I've got the stories, and the best stories lead to sort of the greatest lessons. Let's take a look at the goals for today. Grasping risk. Let's define the challenge. Let's talk about the frauds, the motivations to lie. And it's not always just money. And controlling the risk. And this, so when we get done today, I want you to go, well, now that was useful. That was time well spent. Okay, so that's where we're going here. All right. Let me start by spending 60 seconds on why misreps matter. It matters to the GSEs. It matters to your counterparties, mortgage insurance. It matters to everybody who touches the loans that you're going to do. You got regulatory exposure. So misreps matter in your files, and they might seem minor, but they're not minor when they come back to you with a repurchase demand because of, and then fill in the blank, right? Misreps are the polite way of saying lies, okay? Intentional misrepresentations. I never write that somebody lied to me in a loan file. I say the pay stubs were materially misrepresented. That's the polite way of saying somebody lied to me, but it
Right.
exposes you to risk. That's why we're here. Okay? Now, let me talk about the soup in which we swim. The world of mortgage origination is like any sales kind of operation. You've
Hmm.
got commission driven people. You got multiple parties involved, not all with the same interests. You got buyers and sellers, you got listing agents, sales agents, borrowers, loan officers. You got a power imbalance. We've all seen the power imbalance inside of mortgage lenders between the originators and QC or production. There are power imbalances. Low standards does not always equal easy standards. We're going to talk about the standards that apply when you're trying to get a home loan. So the soup in which we swim is complex. It is made complex, I think, by our compensation structure and the motivations that people have to get loans funded. Think about how irrational borrowers are. If you were about to buy $1 million of stock and an expert came and said, that's only worth 900,000, you wouldn't argue with the expert. You'd back out of the deal. But in homes, we argue. We say that appraiser is wrong, and we take an emotional stand on a big transaction we're about to engage in.
Yeah.
It's a funny soup in which we swim, and it makes people do things that you got to look out for, and it figures into your risk assessment. Okay,
Yep.
so Nate, you and I have talked about the attitudes of originators. We all know originators. If something's denied, one option is to go, okay, and option two is to say, I'm not going to let this deal die, and option three might be, I'm going to pretend I didn't see that and hope you don't see it either. And they're big dogs in our industry that bark pretty loud about
Hmm.
loan quality. We've all been subject to that. And then there's this group that I worry about, which is let's get creative and fund that loan. All right. So
Mm.
this is what we face when you're assessing risk,
That's
right? You
right.
got to be
Yep.
aware of these things. Okay. Now, you've seen these, right, in your world of origination.
Oh yeah, and it's usually the deciding on the front line that's like, I'm not gonna let the deal die. Like we'll dive into it, but the risk, as as much confidence as we want to have in the origination cycle when things are tough, and we were just talking before this launched, things are tough right now. This is a hard market. This is where more often than not you will have this type of first risk hit in a position point that's not found by QC until way later, if even in the origination cycle.
Yep. Yep. The first attitude in your soup, the flavoring in your spice, is I won't let this deal die. There was a headline a year or so ago about a huge producer in New Jersey who got in trouble. And when it first made the headlines, he got in trouble for misrepresenting occupancy. Well, why do you do that? For lower rates and lower down payments. But when the indictment came out, it wasn't just occupancy that they were talking about. This top producing loan officer, huge producer, gets written up in the national periodicals for the amount of business that he was doing, was falsifying the most boring things possible. HOA letters, when the
Mm.
reserves weren't right, when the occupancy wasn't right, he was falsifying HOA letters. Why? Because it falls under the category of I won't let this deal die. One time in a deposition, I asked a broker owner, do your guys falsify things to get loans through? And the answer, first I was expecting an objection from opposing counsel, didn't get it. Guy answered with yes. I said, what type of things do they falsify? And he said, write down to termite reports. And I went, okay, that's a great answer.
Really? Okay.
Yeah, yeah, okay. No objection. I got that answer out of the guy. So occupancy is no problem. Termite reports, smoothing the path for your realtors is a big deal. As a loan officer, you don't want to make the phone call. You don't want to that the condo project doesn't qualify. That you don't want to make that call. There are loan officers out there who go, I'm not going to let the deal die for that. They exist. I'm not going to let the deal die. It might be the realtor who said, I'm not going to let the deal die. So
Yeah.
you get HOA certs, you get the most boring paperwork that
Yep.
gets falsified. And it came out in this indictment of this guy back in New Jersey. Okay. So be aware that I won't let the deal die can apply to a lot of things. I know a guy, God love him, he's a good friend. He drove around with a 4x4 piece of carpet in the trunk of his car. His clients were largely builders, and a lot of the borrowers didn't want to use the builder's flooring. They wanted their own, but they needed a 442 completed before the thing could close. So this was pre-AI, and this was pre-Photoshop abilities. He drove around with a piece of carpet in the back of his truck. He would jam it into the corner of a room, take a picture of it, take it to the next room, jam it in the corner, take a picture of it. And then he provided this as proof that the flooring was all down. So the loan could close and the borrower could put it in his antique refurbished oak flooring. What a silly thing to be falsifying.
Yeah.
442s. What an absolutely silly thing to be falsifying. But notice who he's making happy, the borrower who is looking for a way around the 442 requirements. All right. Gift letters. It's always a form. And I deal in the world of money laundering. And this is a big way that crooks launder money. They get money into real estate in the United States by gift letters. What am I looking out for? I'm looking out for, frankly, different nationalities. Do they match? I had one situation where I had 8 gifts coming into one borrower, all from overseas and all seemingly from different last names, ethnic last names. And I'm like, I don't think you're the dad. I don't think you're, it just was fishy. Gift letters are always on a form because we do not trust borrowers to state, donors to state, I'm giving the gift with no obligation to repay for the purchase of this property to so-and-so who is my so-and-so, right?
Yes.
We
Yeah.
don't trust them to write that letter. Just fill in the blanks.
Yep.
We give them the form. I think if you knew the truth, I think if let's say there's a Vegas over under here, we're going to bet how many grantors of gifts would tell you, I told them just pay me back when you sell the house.
Yep.
That's an obligation to repay. It may not be there, but it's
It's assumed.
what's the over under?
It's maybe not documented, but it's discussed.
It's yeah. If you ask people like, yeah, I loaned my son the down payment for his house. Is it 80%? Is it 75? Which means 80% of our gift letters aren't true. All right.
Right.
I look for gift letters to reveal darker things. I don't mind. I personally don't mind that dad said, pay me back when you sell the house. Doesn't offend me. But I look for gift letters as a way to be exposed to more professional money launderers. Okay.
That's right. Like, where did mom and dad get it? How are they transferring the cash? Where is it? Yeah. Who's sending the dollars behind where, and how are they layering it through?
Yep. Rental agreements. We do this funny thing in mortgages where we take 25% off the rent to account for vacancies and expenses. So you rent the place for $1,000 a month. And so we're going to give you credit for $750. If that blows up my ratios, there are loan officers, and I knew one who faked every residential lease and every loan he ever originated because he took that $1,000 and he bumped it up to $1,300. So when the underwriters were underwriting, they would see, $1,000 a month, and the ratios aren't blown. And this guy had a really funny thing that he did. Every time he did one of these phony rental agreements, he signed it with the name of one of his favorite authors, and he never got caught. Ernie Hemingway. I mean, so if you're doing a loan and you've got Bill Shakespeare as the tenant on your rental agreement, people, Why are they doing this? Because they fall into this category of, I'm not going to let this deal die. You're not blowing up my ratios because you're taking money off of my rental agreements.
Yeah.
Okay.
Or to be specific to that point, you have this countervailing culture structure of ethics decision making where they think, hey, I know the borrower and I know better than the underwriting guidelines because this borrower deserves it. And so they create a means justifies the ends mentality structure to get the deal. Even if it has nothing to do with their pay cycle, they may say altruistically, they may be going, hey, I'm going to be a better person to this American, to this human, to this person. And therefore, I'm going to know better than the guidelines because I think the guidelines are stupid. Well, that actually is a risk. And because we're dealing with humans, you have to consider that as a human risk with human decision making because we're not perfect unilateral decision makers logically.
Yeah. Yeah, exactly right. So I'm not going to let this deal die. Applies to, especially, I should say, Nate, the dumb rules, the rules where you're like, I can't justify that to my borrower or my realtor. Why
Right.
are we taking 25%? Your borrower is going to say, I've had one tenant in that property for 7 years. They're
Yeah.
going nowhere. Why are you discounting me? And then I've got to argue, well, it's the rules. This is how and
Statistically
why.
speaking, it's not the same for everybody, and you're a special case, but I can't give you special case outliers
That's
for
right.
that one. Yeah, that's
And if
that's
the
that's true.
ratios were close, this is how those things happen. So I'm not going to let the deal die can apply to the silliest things, but those silly things result in a loan being defective, right? So there's a defect. If somebody finds that your rental agreement is fake, oh man, everybody, MI gets involved, everybody gets involved. Do we or do we not have a loan that's of investment quality? Okay. So the I'm not going to let the deal die is a very real thing, and you have to take that into consideration when you're assessing your risks. All right. Now let's turn the page and let's go fraud for housing, the serious stuff. All right. So let me give you this example of fraud for housing. Um, People are doing what they can to buy a home, and when I was an originator, and I spent almost 10 years as an originator, I had a good referral from a realtor I wanted to impress to
Hmm.
get a loan for the owner of an art gallery.
Yep.
And I talked to the owner of the gallery. We had a fine conversation and took the application. And I'm doing my charming best to be the nice guy. And then I say, where's your down payment coming from? And the owner of the gallery says, it's none of your business. So, all right, none of my business. I got to somehow convince this guy that I got to know where his down payment's coming from. I try my best. I go away. I go back and tell the realtor, he's being a little stickler. Can we talk to him? We do. We talk to him. He's not budging. He's not telling me where his down payment's coming from. I suspect it is from the sale of an art piece. This guy's dad was a famous artist. I suspect it's coming from the sale of a piece of art. No, not moving, not giving me what I need. And so this realtor pulls the loan from me and gets it funded somewhere else. I have no doubt they just phonied up some bank statements and showed this guy's down payment because he was not moving. Um, Worst thing was, then this guy spends a lot of energy telling everybody in his office that I'm a terrible loan officer. And if I knew how to do my job, I could have gotten this easy loan through. All right. That story fueled me for a long time. It's like, man, come
Mm.
on. You can't malign me because I'm trying to live by the rules. And the answer from
Yeah.
some people is, yeah, I can, because I wouldn't get that hassle if I went to Joe Blow over here. He's gonna get that loan through. And I have no doubt. I mentioned this guy in New Jersey. If they took the loan
Hmm.
to him, he was going to get this loan through, right?
Hmm.
So you're getting pressed. And what I want to highlight for you here, if you're in here looking for principles on risk assessment, this realtor may not be your client for KYC, know your
Yep.
customer identification program. He may
Yep.
not be your client because you don't have a contract with this guy, but he is a risk to you. He has proven that he will push your people to do something unethical. So the next time you get a loan from this guy, do you have to give it an extra look? I think you do. I think this referral source has proven they will push the bounds and push your people to do things they shouldn't do.
Yeah.
Not your client for KYC, but it's a risk. And I think those people deserve to be on lists of yours that you keep about who might pose risk to your company. Let me give you this one: fraud for housing. People want a house. Fannie Mae identified this problem with miracle employment, and they sent out a big memo to everybody saying, look out for employers that are relatives. And it makes sense to look out for this. Here's how miracle employment surfaced. The brother there on the right is a deadbeat. He has a terrible job history. He just can't hold a job. Some are commissioned, some are paid, wildly erratic job history.
Yep.
The guy on the right is super successful as a flooring guy. The Flake brother goes to Good Brother and says, put me on payroll for 2 months, $7,000 a month, 8,000, make me an employee. Let me get a house. And when the house is closed, you fire me, we're done. And I'll pay you back the 16 to 20,000 bucks that I'm going to need from you in terms of payroll to get this house. Well, it's a really good scam because almost everything in that file is true. He has a job. The pay stubs are real. He is employed. There's all sorts of things about it that are valid and legitimate. What's not legitimate? The expectation of continued employment after the deal closes. Mm-hmm. And so Fannie found these and just said, you really got to look out. So what I tell people in terms of risk, if you're talking to underwriters, processors, originators, look out for, oh my God, that guy's a complete flake. And now look at a wonderful job that he has. What are the telltale signs of this? The employment is at a residential address. I checked out one time, and the woman was a bookkeeper, bookkeeper for this company at $7,000 a month. Suddenly her ratios worked for this little condo she was buying. And when I looked at the employer, it was a residence. And when I dug a little deeper on social media, it was her boyfriend. And so it was like, okay, no, I'm not buying the bookkeeping. I'm not buying it. Pay stubs are real. Verification of employment is real. It's just not real employment. It's not going to exist there next year. So look out for somebody's life is a mess. And now suddenly it's not a mess anymore. It's great. Fraud for housing. Example 3. Granny's not moving from Waikiki. I had a loan where Granny, living in a house literally overlooked Diamond Head,
That's crazy.
was moving to North Las Vegas, and I called BS. No, she's not moving from there. I've been to North Las Vegas. She's not going to North Las Vegas. So I called her, and we had a charming conversation. She was lovely, and she said, "No, I'm co-signing that condo for my grandson who's going to UNLV." I said, "Okay."
Wow.
Talked to her for 20 or 30 minutes. The next day, the grandson or nephew called me to say that he understands I talked to grandma, and sometimes she gets confused and you shouldn't believe things that she says. And I was particularly incensed at this. My mom passed of Alzheimer's. So throwing grandma under the bus for Alzheimer's when that is not what was going on really ticked me off. Yep. Okay, so what have you got? You've got fraud for housing. Somebody wants that housing, and they're a student in Las Vegas, and they don't qualify. So who do we say is going to be there? Granny. Maybe she didn't have the down payment for a non-owner, and to say that she was going to rent this in Vegas. So they said she was going to live there. Yeah. Didn't make sense.
Because why? Because I mean, your risk profile is less. It's going to be a primary residence. Like everybody rates it. The lender overlays are different. The secondary market rates it as a different risk. It fits the QM status structure better. Your ability to repay is different. Like this is one where has been on the news in the last few years at a high level, and we're still seeing people do this. And then even recently, there was an individual found guilty of this in a large capacity point and is dealing with quite a bit of legal issue. Like this is not one we can just say, oh, it won't happen to me. It won't happen to us. This is a high level of risk because, and this is where I think that our technology impact outside of GLBA, outside of customer information security, outside of all that, your usage, and I think we talk about this a little bit later, Bob, but your usage of technology and AI is risky, but also understanding that your borrowers are being coached by AI bots and questions they're asking without being asked, without being actually trained. They're being coached. Here's how you buy a condo in North Las Vegas for less money or with less risk or better rates. It has to be like they're maybe not the AI is not ethical. It's only responding back in the way that makes the user feel happy. So I think you have to understand in your risk analysis, our consumers are now using tools that are giving them poor information that we have to overcome and we have to look out for. They're being
Yep.
coached, even if it's with not ill intent. They're being coached to be fraudulent.
And let me add another layer of complexity to what you've just said about this coaching. I think you must decide whether you have an HR issue here. Could this
Yeah.
have happened without insider knowledge? Insiders do take advantage. I think obviously this loan officer then was worried I was talking to Granny, but do you have an HR problem? Is this, when I do personal trainings with people, I talk a little more casually than when I'm recorded, and it might show up elsewhere. But what I say to people is, to this loan officer, are you crooked or too stupid to work here? You believed that Granny was moving from Waikiki to North Las Vegas. Did you believe
Right.
that? Or did you coach her through this and expose me to liability because we might have done an owner loan that was really non-owner? So
Yeah.
are you crooked or too stupid to work here? Don't quote me on that, but it's real. And I need my loan officers to be smarter than this. I need
Yeah.
them to understand when you're seeing an 84-year-old woman who's moving from Waikiki in a paid off house to go, really? I'm not buying it. So it can raise HR issues, and this is where it gets dicey and touchy. Okay.
Good. That's good.
All right. Nate, you mentioned coaching. Sherman Oaks, California, just on the other side of the hill from UCLA, is the little house on the left.
Yes. Mm-hmm.
Okay. Bel Air, the Playboy Mansion, right next to UCLA. Bel Air, lovely little Tony part of town. I had a loan where the guy said that he was occupying the house in Sherman Oaks, and I did not believe him. And I called him, and he had the perfect answers for me. He tried to convince me that he was really living in the house on the left and not in the house on the right. What did he say? On the day I closed on that house in Sherman Oaks, I was fully expecting to live there. And we all know that with regard to occupancy, it's your intent on the day you close. If you get divorced, job loss, your spouse dies the day after you close and you decide not to move into the property, you aren't violating your occupancy clause because life happens and you intended to close. This guy had his answers down absolutely perfectly. And the reason I couldn't tie it to him was his background was commercial real estate. So I think he was just a sophisticated player. I couldn't say for sure that he got coached through this by a loan officer. He was sophisticated. All right. This one I call Betty and the tax returns. I was a loan officer and I got hit by a borrower crook. She was a successful real estate agent in Newport Beach, and she asked me to pull cash out of her house. Looked pretty much like this house. And she slipped me fake tax returns. Years later, I got a call from the FBI. Bob, Mr. Simpson, did you do a loan for Betty? I said, no, I didn't. I said, we think you did. I said, I don't recall it. And they said, you better come talk to us. Turns out I did. What I remembered, and I told the FBI, no, I didn't do a loan for Betty, was she had called me after this loan closed, wanted more cash, and I had to turn her down. And I spent 10 minutes getting her insults about how I didn't know my job, and if I did, I could get her more cash out of this house. So all I remembered was the scolding. Well, the FBI quickly refreshed me with loan docs that I had done this loan for her. She hit me with fake tax returns. She hit a Vegas bank and a Phoenix bank. She actually got convicted of mortgage fraud and she fled the country. The lesson I take from this is that pros in real estate, they can use their professional reputation to get you to let your guard down. I was so
Absolutely.
happy to meet this woman. I was going to do Betty's house. And I got wowed a little bit. I got wowed to do loan for somebody that I shouldn't have done. And that can happen to, I'd like to think it can happen to you too, Nate. You get
Oh yeah.
wowed and you want
Yeah.
that business and you don't want to hassle them, right?
It gets so easy because they know the lingo, they know the terms, they know the things. They basically make you feel so much more comfortable because it's like you do let your guard down on the origination side. I've had this happen. I don't know that I've had fraud happen because of this, but you do have somebody talk to you because they feel more confident with it. They're using the same lingo you use. It just flows a little faster. Things go a little better, and you aren't necessarily on your guard for potential fraud because they're in the industry. They're licensed professionals.
That's
I
right.
think you talk about that at one point too. They're trusted, right? Just because they're police officers and firefighters and licensed professionals doesn't mean they're the same ethical level that you are.
That's right. So you look for pros who are using the reputation to get you to relax. And that is a key here. So how would risk professionals respond to this? Well, um, with a conviction of one of my borrowers, I think I want to pull other loans that might involve their closing agents, might involve
Hmm.
their realtors, might involve other properties of theirs. I think I might want to do some due diligence on that person. Um, I'm going to mention this one, a big Atlanta problem that we had that involved just that closing agents, three closing agents who were working with a guy named Phil Hill to fund hundreds of fake land flips in the Atlanta area. And the key to it ultimately was the biggest case I ever handled. It was more than 600 loan files that I personally investigated. Um, Phil preyed on UPS drivers, oddly enough. He got them all in like a multi-level marketing, and he paid them all 10 grand to sign loan docs. Phil's pitch was, I'll pay you. You borrow the money. I'm going to rent all these things out. I'm such a successful big investor that Fannie won't lend to me directly anymore. And he had all these glossy brochures, and he convinced everybody he was a big, real estate investor and landlord in the Atlanta area. Well, he would buy
Wow.
a house for cheap, condos. He preyed on these condos. He would buy it for cheap and sell it to these unwitting UPS drivers for twice that. They would take out a big loan on a falsified appraisal.
Hmm.
And then he had three crooked closing agents, at least three that I investigated, who were dispersing the cash. And yeah, it was quite a racket. Fraud for profit is a big deal. Um, Pros, crooks, take advantage of you, me, and the borrowers. There was another Atlanta matter that I handled that I think is instructive as well, and that was first payment default and an appraisal that was wildly off. And so, as a fraud guy, I'm like, oh man, what have I got here? This is a bad set of facts. First payment default and a property that should have been worth 2 million got
Yep.
appraised for three. And it was like, oh, how are we so wildly off? Well, I just decided to call the borrower, and I got the guy right away on the phone, and he was an entertainer. And he said, yeah, I bought this house. I knew I was overpaying, but it was stuffed full of recording equipment. Basically, I had a full recording studio for me there. And he goes, and I showed up, and it had all been stripped out. I knew I was overpaying. So the conversation with the borrower totally changed my attitude. I thought I had a land flip. I thought, what's going on here? Turns out we had a victim borrower. Okay. So borrowers aren't always, you know, in on it. This guy
It's true.
got scammed by somebody who then took all the recording gear out of the house. And then he followed up with, who do I send a check to? Let me just pay this off. I thought that was one of my most successful fraud calls I'd ever had. Gave him the general
Wow.
counsel's number and they paid it off. Point is, you can see fact patterns that make you think you've got this risk when in
Yeah.
fact you have a different risk. Okay.
Yeah.
All right.
Second
Um,
and third layer risk issues are definitely they fall through. Don't just stop at the first thing that checks the green box. You have to look deeper.
yes.
Yeah.
Yes. Um, Nothing good comes from a Vegas boyfriend. I looked at a file with 4 or 5 loans on it, and I asked the girl about her multiple properties, and she said, I don't own multiple properties. I have one in Las Vegas. I said, nah, you got 4 or 5 here. And so we looked at the schedule of real estate. She didn't recognize any of the properties, but they were all there. And so then we looked at the bottom of the 1003, and the loan officer was her ex-boyfriend.
Mm.
And it was like, oh, I think I see what happened here. He took her identity and he bought a bunch of rentals in her name, 5 of them, as I recall. The lesson here is insiders have power and insiders take advantage of people. So you have to pay if you're attention to this. If you're managing risk at a mortgage lender, you just have to be aware that sometimes you're going to get these answers like, no, I don't own multiple properties. Yes, you do. And then there's a story behind there, right?
Yeah.
Because it didn't just happen that she owns 5 properties. It was somebody, she was a victim. She was a victim of bad behavior by somebody who had all of this knowledge. This is why Palantir having every bit of information on everybody in the country makes people nervous. It can be used for good, but man, if somebody's going to use it for ill, it's the bad boyfriend thing. Okay. I talked about Phil Hill and the UPS drivers. So I want to mention another example of fraud for profit, of smart insiders taking advantage of the system. My client had a construction to perm loan program. And the idea is, of course, to help you build your dream home. You take out the construction loan, it doles out over time. You build the house, you convert it to a permanent loan. Great product. Unfortunately, in this area of Tennessee, a local felon wanted to be a local home builder. So he enlisted straw buyers and said, you apply for the loan. I'll pay you 10 grand when it closes. Give me the proceeds. I'm going to build out this neighborhood. So he enlisted straw buyers. They filled out the applications as if they were going to own these things, as their primary residence. And we found out about 30 different loans. This one crook was behind it, taking the cash and building out this neighborhood. Well, he built a great neighborhood. Congratulations. But we thought we had 30 owner occupied loans. Now they're not of investment quality. It's a big mess. So what have we got? We got insiders, smart insiders, maybe felons, taking advantage of programs like construction to perm to do things with it that expose you to liability. That's a big deal. And so if this were my department and I were looking at this, I would have interviews with every loan officer who touched one of these things. What's your relationship with this felon builder? How did this guy find you? It would be really bad if all of these loans ended up on one loan officer's desk, because how can you be a loan officer and avoid the question, so you're building your dream home? What, you mean they never, out of 30 people, answered correctly? Oh, no, it's not really for me. It's for Joe Blow over here. You have a duty, if you're the loan officer on these things, to ask people certain questions and be informed. And so, yeah, if all these ended up on one loan officer's desk, we do have an HR issue. All right. So you can't stop what you can't spot. So you got to train, you got to get in and with your book of business, if you don't have construction to perm loans, that last example doesn't apply to you. You may have other things that apply and are your particular risk. So you've got to spot these things if you are going to stop them. So describe a dozen frauds when you're talking to your people. Tell them there's no honest professions. You could have fraud in a priest's file, a cop's file, a teacher's file, a nurse's file, a doctor's file. You could have fraud anywhere, because we've just been through a bunch of scenarios where it isn't the borrower pulling all the strings, but things get done. Okay. So when we're pulling files to review, I say underwriting is different. We have all kinds of rules about you can't prejudge people, right? We know those rules, right? Are we still making 30-year loans to people who are 80 years old? I guess we are. But underwriting is different than red flag management. Red flag management, I use the example of my own father. Rest his soul. He worked until the Sunday before his retirement luncheon. It was going to be a Thursday. And Dad was a judge in Los Angeles. And if an underwriter had looked at my dad's loan and said, does this old codger drive himself to work every day? Yeah, he does. I would expect a red flag reviewer to look at my dad's loan and go, wait a minute, what? Is this really? This guy drives to LA every day? He really did. We have to make him the loan because he applied for it, but I'm going to expect that red flag and risk people look at loans differently, not as an underwriter, but as somebody who says, does this make sense? I had one borrower, she was in her mid 20s, and I asked what she did. She said she's an admin. I said, what do you make? 400,000. I'll never forget it. I'll never forget the casual way she just dropped the figure 400,000 on me. I just couldn't believe it. She was working for her dad. The dad kept 2 or 3 of his kids on that kind of payroll at his office. It was a printing company, and it was an honest answer, but man, was it abnormal. And when we are examining our risk, we got to examine normal versus abnormal. You have to have the freedom to do that and not feel like you're an underwriter. You're not. You got to be able to report, and you need the support of management to handle this task. So now, guiding principles for us here. I'm sorry to give you so much to read, but I highlighted stuff in yellow so you can just go straight to the word that matters. Here are the points we talked about today. Here's the risks that can come up and get us. Trying to smooth the path for professionals, helping borrowers. Commissions are at stake. It makes us make some decisions we shouldn't make. Sometimes there are ridiculous rules that we live by, and sometimes people get angry with those ridiculous rules.
Yep.
Conniving is real. Ask our New Jersey loan officer who was falsifying HOA certs. Pros use their reputation to get you to relax.
Yep.
And pros prey on people. I love the alliteration there. And some insiders are just crook. They're Vegas boyfriends. Nothing comes good from Vegas boyfriends. So these principles need to guide your risk assessment when you are looking at, how do I get my hands around this? Take lessons from your book of business, the kind of loans that you have, and the risks that you might be exposed to. All right. So was that useful? I hope it was.
That was darn straightforward. Don't have any questions, but if people have questions, feel free to throw them in here. If you've got anything you want to ask specifically while we're on here. But Bob, I think when we lean forward and you do a risk assessment, the one thing you didn't show was like that color grade, the presentation deck. Did you? Wait, was that the very beginning? You've shown that before, your Excel spreadsheet, right? You rate your risk through your heat map, one through 4, 1 through 5.
The grading scale is up to you, but that's the heat map that shows where your risks would come from.
Yeah. That's the challenge. And here's the thing. And I can't stress this enough. If you're a newer compliance person, if you're just running a shop, if you're a branch manager thinking, hey, I got to get this done because I'm being told by compliance they want a 1 for my branch. It's kind of like nobody believes there's no risk. So don't try to say there's no risk. Don't be like, oh, we're green everywhere. It's like the heat map is I've really got no risk because we're so clean. It's that actually shows and is a flag itself for an examiner in any kind of capacity because you're not thinking about your business correctly. Risk is baked into interest rates and loan programs and payback cycles and secondary markets. It's all baked into the system. We expect a percentage of fallout and defaults. We expect a percentage of EPDs. We expect a whole bunch of things to go wrong in a industry where trillions of dollars is trading sides annually, even in something that feels compressed. And so to take a list and a heat map and say, and I'm just speaking to other loan originators or maybe your branch manager, and just say, hey, look, I've had to do these too. And you're like, oh, I feel like a failure if I have a 5. No, you're not. You're a failure if you mark it a 1 and don't acknowledge a 5 and don't put into compliance or structures or policies and procedures how to help alleviate the risk that you have identified rightly as a potential leak in your boat. And so when you do your own heat map, call Bob if you need help. He's got a fantastic product and a process for you to walk through. But when you do your heat map, just be honest, because when you turn that over or it gets looked at by examiner, if it's all green and low risk, like you don't know your business, we should probably look a little deeper. And
So
if you actually have things identified, you're going to be a bit safer because you've thought through it.
exactly right, Nate. The worst thing you can say is we don't have risk, where it's all controlled. I used to think that it was outrageous that my clients would ask me what were my plans in the event of a pandemic. Well, my opinion about that changed, and I think that every business card of every risk manager should say, "I'm never surprised." You're never surprised. You thought about everything from pandemics to measles to anything. You're never surprised, and to assess that risk, 2 points. The BSA regime says you must do a risk assessment. And I'm seeing clients come to me because they've been written up because their risk assessment is not adequate. It's,
Yeah.
one page for an entire organization. So if you, the pitch would be, if you feel like you need some help putting some structure around a risk assessment, happy to help you with that. But my clients are coming to me because they're getting banged on by regulators, states, to say, you have an obligation to do risk. What are you doing?
Yep.
And this is where sometimes people. I attended a risk session seminar down in New Orleans, and the leader the first morning said, "How many of you have trained in risk assessment?" Room of 500 people. Like two hands went up. The rest of us stumble into risk assessment and kind of learn it on the job. It can be something where BSA officers feel like they need some help.
Yeah. And it's okay to get help because sometimes a second fresh set of eyes. Bob, we were on our risk and roll podcast that we do every couple of weeks with some other compliance people. And I think you brought it up well. When it comes to risk assessments, BSA AML, getting your documentation done, this is a great trigger for everybody. Look around your office, look at your team, see who loves true crime podcasts or dystopian type literature and say, hey, I need you to come sit down with me, and I want you to be the creative one thinking about every which way this thing would show up in a true crime podcast or like if you were going to write a story about the worst case scenario, what would it look like? You need really good compliance people who do a risk assessment well are imaginative. They are okay walking down the steps of what does the worst day down this path look like, and they can identify it and they can name it, they can color it, they can tell a story about how it got there, and that way they're able to pull back and go, okay, what are the triggers that I would see in an assessment that would make me think now we're walking down that path, and what could I look for to stop sooner so that the risk does not proceed. So get the creative people in your team to start thinking and telling the stories of the worst day ever that they could imagine.
I agree.
Yeah.
Nate, pleasure.
Yeah, like always, sir. Hey, if you stayed in this, we've got a number of people that stayed all the way through. I appreciate you being here. What's going to happen is in the next couple of days, you're going to get an email from MLOForce. We're going to send you a certificate of completion for your BSA AML annual red flags review. Thank you for hanging out with us. If you need help in your continuing education, compliance training, things like that, check us out at MLOForce.com. You've got some great opportunities with us. We've got that. If you have not done a risk assessment, call Bob. There's his email address. There's his phone number. Get a hold of Bob. He will come in for a lot less than a fine and definitely a lot less than hiring just another person. He comes in and helps review and analyze your risk assessment, coaches you, and make sure you're on the right path. It's just something that even one of the early times when I met Bob, we started doing it at the small brokerage I was at because it was like, look, it's like an insurance plan. At least we know our documents are right, and then if we miss the risk, at least we can say, hey, from a QC, from a management side, we were prepared, we just missed that, and that may not be our fault. So
Email's right
that
there.
is something.
Hit me up.
Yep, do it. All right, y'all, have a great week, and we'll see you on the next call. If you come back, if you need more of these, just let us know.
Thanks, Nate.